Awesome. Let's go ahead and get started. Good morning, everybody, and welcome to the Business Masterclass today on the impact of inflation, interest rates, and the economy for SMBs. My name is Chase Gardner. I lead APAC partnerships here at Employment Hero. Before I introduce our guests from Findex, I want to do a bit of housekeeping. So we've allocated about 15 minutes at the end of this webinar to answer any questions you may have. So please type as many questions as you'd like in the Q&A section at the bottom of your screen in Zoom. And we'll get to as many questions as possible from our panelists. So I'm really excited to be joined by a great team here from Findex. And so introducing our guests today, we've got Rachelle Nowland, who's a senior partner in accounting and business advisory from Findex. Rachelle's been a part of Findex business since 2002. She brings a wealth of knowledge and experience in working with small to medium businesses on business management and taxation issues, as well as partnering with them through their growth journeys. We also have Daniel Lanna, a senior partner of lending at Findex. Daniel leads the team of Findex lending advisors in New South Wales, the ACT, and Queensland, with a corporate banking and finance industry experience stemming back from 1996. Daniel has been a part of the forefront of the financial services industry and ranked in Mortgage Professional Association top 100 broker for several years. We're also joined by Matthew Swieconek, head of investor relations from Findex. For more than 20 years, Matthew's held a variety of client advisory and corporate roles across the wealth management industry in Australia as well as the UK. Matthew works in collaboration with the Findex investment team and Findex financial advisors to help construct and deliver Findex investment propositions to clients. So thanks everyone from the EH side that's joining as well. I will hand it over to Matthew to kick off our presentation. Thanks, Matthew.
Thank you very much, Chase, and congratulations on the pronunciation of my surname. You nailed that one. It's not an easy task, I appreciate. So look, as Chase mentioned, my name is Matt Swieconek. I'm the head of investment relations at Findex. I'd just like to say thank you very much to the team at Employment Hero for hosting us today and allowing us to present to you all. And thank you to all of the attendees for joining along. We hope you do take some valuable points out of the session today. We're certainly really excited to be here presenting for you. Just onto the disclaimer. The disclaimer, while all reasonable care is taken in the preparation of the material in this presentation, to the extent allowed by legislation, Findex accepts no liability whatsoever for reliance on it. All opinions, conclusions, forecasts, or recommendations are reasonably held at the time of compilation, but are subject to change without notice. Findex assumes no obligation to update this presentation after it's been issued. You should seek professional advice before acting on any material. So our webinar contains general information only and is not intended to constitute legal or taxation advice. If you do need legal or tax advice, we recommend that you speak to a qualified advisor. Try saying that 5 times quickly. So with all that said and done, the agenda for today, shortly I'll provide a brief overview of the main economic issues that we know are really probably topical for many of you on this webinar with regards to interest rates and inflation. I'll then hand over to Rachelle Nowland, who will go through a session on business planning for improved outcomes before handing across to Daniel Lanna, who will give an update on lending solutions for small to medium businesses. So before we kick off, just a little bit about Findex. Some of you may have heard of Findex, but I'm guessing there's probably a number of you out there that haven't come across Findex before, despite the fact that we have been operating in Australia for over 30 years. We're the largest wealth and accounting business, across Australia and New Zealand. We have over 100 locations across both of those countries. We have just shy of 3,000 employees. And we service nearly 250,000 clients, primarily across the SMB space. So we are SMEs in the SMB space, if you'd like to put it that way. We also manage some $17 billion in funds under management on behalf of private clients and not-for-profit organisations. On the right-hand side of your screen there, you'll just see a little what we call a cheese wheel of the services that Findex does offer. We're very diverse in terms of the service offering that we bring to the table, from tax and accounting services, audit, corporate finance, and of course, wealth management, risk insurance, general insurance, and lending services, which we'll be talking through today. So where are we now in terms of the economy, and particularly with reference to SMBs? Well, I think that the conditions can probably be summed up in one word, and that is it's pretty tough out there in the economy, and it's been progressively becoming more and more difficult, particularly with rising inflation. We saw inflation hit its crescendo in December at 7.8%. That was the highest that it had been in some 30 plus years. It has since come off to 7% in the last reading in March. But obviously it's still very high and elevated in historical terms. We thought that inflation would be really a transitory problem coming out of COVID, as people were coming out of lockdown and living their lives again and traveling and visiting restaurants and so forth. But unfortunately, with the Russia and Ukraine crisis that's been occurring over the last 8 or so months, that's really exacerbated the inflation issues. It's stifled supply chains and made raw materials and goods much more expensive. So as a consequence, we're seeing central banks globally start hiking interest rates really aggressively on the back of this inflationary problem that we've had, in an attempt to try and bring inflation back down to, a 2 or 3% range, which is a long way from where we're currently sitting. So only recently, as in yesterday, we saw the Reserve Bank here locally increase interest rates again to 3.85%. And if you think back to where we were this time last year, we were sitting at 10 basis points. So the 4th of May 2022, so tomorrow marks the 12-month anniversary, is when the Reserve Bank started hiking interest rates. So in the last 12 months, we've had 11 increases, which is really unprecedented, and it's making life very difficult in a private, personal, and also a commercial sense for many people who are really struggling with cost of living, and interest rates are a large part of that. So we've had a situation where obviously mortgage rates and lending rates have followed suit from the successive rises in interest rates. The average variable mortgage rate as of yesterday was 5.91%. We will see that increase on the back of the 25 basis point move. So variable mortgages will likely breach 6% at some stage in the next few weeks. And I'll let Dan probably talk to that in a little bit more detail later. But we've also had this situation where shortage of skilled labour or labour in general, and lack of migration into the country has driven this labour shortage. And as a consequence, many of you out there are probably struggling with the ability to employ labour to fulfil many different roles. And as a consequence, that labour shortage is been driving wage growth. So you've had this perfect storm of rising input prices from raw materials, energy costs are going up, your power costs are going up, the costs of wages for staff are going up exponentially. And we're seeing this unemployment rate that is as low as it's been in 50 years that's driving a lot of that. So obviously, the costs of doing business are increasing significantly, and that can only be passed on to the end consumer to a point. But beyond that, businesses are wearing a lot of that increased cost, and as a result, I'm sure many of you are feeling the pinch as far as your margins are concerned at the moment, just as a result of a lot of those factors. So where do we think interest rates will end, or what they're calling the terminal cash rate? We're pretty close. We're definitely pretty close. The board papers from the Reserve Bank yesterday do suggest that they're leaving the door open for another rate rise. Hopefully they don't, but there's always a possibility that over the next month conditions don't improve from an inflation perspective, so that happens. So the terminal cash rate will end up somewhere around 3.85 to 4.1% in our estimations. The concerning part is that we have somewhere in the order of 20 to 23% of every mortgage in this country being refinanced this year. So in round numbers, that's somewhere in 800,000 mortgages, or about $350 billion worth of loans that are being refinanced. And when you consider that the majority of those loans are going to be coming off somewhere around 2% or even sub 2% to 6%, as I mentioned beforehand, you're going to have people who are on the average, let's say average mortgage of 800,000 going on, increasing their interest repayments from 16,000, let's call it, to $48,000 per annum. Where do you find an additional $32,000 to pay your interest repayment on your loan when that resets? And for that very reason, we expect that there are going to be some dramatic knock-on effects to the end consumer, and that is obviously going to dent discretionary spending, so people's tendency to maybe travel or eat out or buy those discretionary items, those luxury items that they may otherwise have been purchasing, because we have been seeing savings rates coming down as well to pre-COVID levels, even though the government did stimulate the economy with a large amount of stimulus and payments and so forth. So we do expect that consumers will struggle over the course of the next 6 to 12 months, and there are going to be flow-on effects into the economy over that time frame as we see these mortgages roll over. So that's kind of the bad news, but I think it's not unknown. I dare say, as business owners and people who are running your own businesses out there in broader Australia, you're seeing this every day of the week. And these are factors that you'd be well aware of. I guess the good news is we are, and even the Reserve Bank is saying in its own board papers that they expect that inflation has peaked and has come down from here and is on a downward trajectory. A lot of those cost pressures, the input cost pressures, so particularly into the building industry and so forth, those raw material costs, we are seeing a stabilisation in many of those. That did stem from that Russia-Ukraine invasion that I was speaking about earlier on. So we are seeing a moderation in those input costs, albeit they are still high relative to a historical sense. There is talk of an easing in interest rates next year in 2024. We don't anticipate that'll happen this year. We don't think the RBA will pivot that quickly, but at some stage next year, there will be most likely an easing. Now, the Reserve Bank is sort of suggesting that might be down to 75 basis points off where they currently sit over the next 12 months and then into 2025. But it really is difficult to see what that number may look like. And of course, look, relative to a historical sense, we do still sit below where the mean average variable mortgage does sit. Now, when the banks do start to adjust their variable mortgages on the back of yesterday's rise, we will achieve that medium, but relative to where we sit, relative to history at the moment, I guess we are still just sitting there at that average, albeit we are coming off a different situation in that most people did finance it at a much lower rate than where they currently sit. So that's it from me from a macroeconomic perspective. As I said, these are issues that I'm sure you're dealing with on a day-to-day basis. I'll hand over to Rachelle now, and she'll go through some of the forecasting and business planning work that she currently does, that our business planning team currently does with small to medium businesses. Thank you very much.
Fabulous. Thanks so much for that, Matt. It's interesting, some of the stuff that I'll go through is probably a reflection on the environment that we're operating in at the moment and how those external factors actually fit into business planning. So, yeah, we've had a lot of businesses learn to pivot quickly over COVID. It's a skill set that I think is probably going to stand everyone in pretty good stead over the next couple of years as the situation we've got now unfolds. And of course, to throw back to Kenny Rogers, you've got to know when to hold them and know when to fold them. So one of the really key areas that I think is really important is, despite the fact that we're looking at the headlines about, just looking at the headlines this morning, RBA lifts cash rate in shock decision, massive interest rate to hit millions of Australians already. the news media really makes its living off shock headlines to really focus on the negatives. And whilst I'm not taking away from how challenging that will be, one of the really important things to do in business is really curate your own sources as to what's happening in your marketplace. How do you get that information? How do you develop a bit of an advisory board for yourself, whether it's a spouse or maybe not a spouse, maybe it's a friend, maybe it's a business group, maybe it's your accountant or your advisor, to really bounce some of these ideas off and try and develop your own sense of where your business and where your industry is headed. Now, whilst we've got those interest rates that are being headlined at the moment, one of the positives, and I know that it's adding some challenge to business as well, but one of the positives is that we've got this, very much, lowest unemployment on record. Now, the benefit of having those incredibly low unemployment rates is everyone's still got an income to spend. And that's one of the things that will continue to flow through into business confidence. So yes, listen to the media, but also make sure that you curate your own sources, and so feed that into your forecast and build your own confidence in your own business outlook. It's important to consider, and I think we'll cover that in the next slide, is that there's a number of different businesses on this call. So it was a little bit challenging to try to find a source, a couple of examples that fit to everybody, but it comes down to like, we've got a lot of these fixed rates that are going to come off in the next 12 months. Yes, that's challenging, but yes, that's challenging for parents with a mortgage and kids. If your marketplace is people heading towards retirement who are actually experiencing an increase in their income because their interest rates are going up, they may not increase their spending significantly, but it's also probably highly unlikely that they're going to drop it significantly either. If your marketplace happens to be 20-somethings that can't save for a deposit, so they're still living at home with mum and dad, then all of a sudden, they're still, so long as that unemployment rate stays low, they've still got their income to depend on. They're not going to be directly impacted by those rising mortgage rates. So you may actually find that demographic is still quite well protected. And the people that are buying $40,000 fridges are probably still going to buy $40,000 fridges. So again, it's around what's the demographic of your market, or if you're in a B2B business, what's the demographic of the business that you're servicing? What's their disposable income levels? What are the drivers that are influencing them? I spoke about just understanding the messages that are coming through from the media to you and how to distill that into what's really happening. But I think it's also important to be looking at what's the messaging going through to your marketplace. Because again, if what they're getting from the news cycle is doom and gloom, how do you as a business, and how do you also influence your industry bodies to be actually coming up with messaging that cuts through that and actually talks to the silver linings that are happening in these areas? So it's really, this isn't directly financial stuff, but it's all this information that flows into how you build your forecast and how you build, for example, if you do have a market where there is a direct impact from rising costs and rising mortgages, what's your opportunity then to pivot into a semi-related field that might not be hit quite so significantly? So it's important in this forecasting process, to look at all of your input costs, to look at your service lines, to look at the profitability of those service lines or product lines, which ones are impacted by those rising costs, which ones might not be so much. So giving yourself the knowledge and the information to be able to assess where that's at and to make a pivot relatively quickly. It's a really good opportunity to review your own pricing strategies. So again, this is the silver lining that comes with it. We've had a low inflationary environment for, I think if we look back at the graph that Matt shared, we've got that low inflationary environment that's been around for the last 10 years at least. And we haven't had in business the need or the driving need to have quite such an eagle eye on how we maintain our pricing and how we actually communicate that out to our customer base. So there's a few businesses that have gotten into the habit of reactionary pricing rather than having a proactive pricing strategy. And a lot of that is around how you look at the drivers behind that, how you communicate that to your staff so that they're all on board as well, and how you communicate that to your marketplace. So being positive about it, looking at the bright side, using the opportunity to build your communication strategies around your unique value proposition. Whilst there's a challenge there, you can also use it for good to get yourself into some really good habits going forward as well. One of the things that should help you build your confidence in this space too is using some good modelling. So if you haven't repriced for a while and you're looking at your input costs and you're thinking, I really need to put my prices up by 20% to maintain my margin, 20% sounds like a massive increase. But if that 20% does mean you'll have a volume fall, what does that mean in terms of how you model out the input costs that go into that? So reduced input costs because of reduced volume. Is there reduced staffing? Is there reduced freight? You might find that a 20% fall in your sales, or a 30% fall in your sales as a result of a significant increase might actually still return you the same net margin that you're making now, so that you're no worse off. And so knowing where that point is a bit like calculating a break-even point for a business. Knowing where that point is will build some confidence. And when you put that into play, you can be monitoring what the impact of that is on your sales volumes, and then adjusting accordingly, or adjusting the messaging accordingly as well. It's important to be looking at your overhead costs. We've all got increased overheads. Some of them are shooting up faster than others. Some of those, as Matt was saying, wage levels are increasing because of labour shortages. And it's a question there around whether it's a cut, whether it's a control, or whether it's a substitute. And so part of that is around looking at which of those overheads, whilst they're overheads, what is the key driver into sales, or what's the key driver into viability, and just making sure that something isn't cut just because it looks like an easy win. I think everyone's probably well across that anyway, but sometimes it doesn't hurt to reinforce it. What does a substitute look like? Well, maybe that's the staff morale piece. Is it around, if you order in drinks every Friday, is it maybe switching it out for a barbecue once a month? This is where your communication piece becomes really important. What are you doing, and why are you doing it? And how do you bring customers along for the journey, but also how do you bring your staff along for the journey as well? If it comes to staffing levels, and we're starting to see some pressure, if we start to see some pressure around having to reduce staffing levels because of reduced volumes, if we start moving into a recession, particularly a challenge in your marketplace, then how do you actually go about managing that in a proactive and empathetic way? So very important to come back to the values that you have, why you're in business, what your value proposition to your staff is as well. And if there needs to be shift reductions, or there needs to be staff level reductions, making sure that you're proactively communicating the why around that, and living your values through that process will come back to pay dividends in the long run. And then finally, I'm an accountant by trade, so I'm always going to say keep your data up to date. But when you're modelling for the impact of a economic change, or the impact of a business pivot, it's really important to have your data up to date, and it's really important to have your data clean. As a business owner or a business manager, one of the important things for you to do is to be making sure that you've got information that lets you see the forest, not actually just looking at the bark of every tree. So it's really easy to get bogged down in the details. So how do you build snapshot reporting that gives you insight into the business performance, but also how the key drivers that you've identified for your business are actually tracking. So those forward-looking drivers that give you an indicator of what's happening and how it's going to impact on your business. So there's a number of programs that you can use around there. A lot of them will link back into your bookkeeping data systems. And a lot of that is around finding the tech stack or getting someone to help you find the tech stack that suits your business so that you can focus on the high level information and not get bogged down in the details. It's around outsourcing the stuff, outsourcing the noise, making sure that you're doing the $500 an hour work and not the $50 an hour work. Where do you add most value to your business? What gives you the most joy? And that's where the revisit your why comes in. So why are you in business? What gets you out of bed? What motivates you? What brings you joy during the day? And making sure that you revisit that on a regular basis, because that will drive your intent, and that will come through to your customers, and that will come through to your staff. And it will also help you make those value decisions that say, well, I could do this and it will save me money, versus I could do this and it will add so much value to my business. So really helping drive that decision-making process, particularly if there's a lot of external noise in the marketplace. And finally, small business in particular has what I'll call a bad tendency to risk underpaying themselves. So just wanted to reinforce that while it might sound like a noble thing to cut your income to keep the business afloat, that you need to make sure that you're looking after you as well. That becomes even more important if the business does unfortunately get into tricky times. There's also a lot to be said for having really solid business structures and really solid asset protections, and then making sure that you're pulling that personal reward back out of the business on a regular basis as well. That, I hope, will give a reasonable overview to the situation that we're facing at the moment. While there's a lot of media doom and gloom, I think things like the fact that there is a record low unemployment rate actually feeds into some confidence that there's still plenty of money circulating in the economy, and that should hopefully hold us in some good stead for the next little while. I'm going to throw over to Dan Lanna now, the senior partner in our lending division.
Thank you, Rachelle. Hi, everyone. Thank you for having me. As mentioned, I'm one of the senior partners in lending for Findex, talking today about lending solutions, a little bit about the landscape, and so forth. I think we'll start off, as we can see, there's a little bit more about lending in general with Findex, our proposition, some of the banks and lending partners that we deal with, the different types of lending and how that's possibly actually changed and evolved over the last few years, structuring and a little bit of advice at the end of it. A little bit about us. Findex Lending is one of the largest brokerages in the country. We have about 35 advisors covering Australia nationally on a national level. We write approximately about $800 million worth of business and have a portfolio of over $4 billion. One of the positions that we hold with our clients is that we're their advocate. We're not a bank. We're not aligned to any particular bank, and therefore we remain fairly independent. We provide funding solutions for our clients, taking into consideration their needs, situations, interest rate tolerances. We provide an independent assessment of their current situation. Again, the client is sort of first and foremost, and we do provide routine audits. Next slide, please. Sorry, I think we haven't. One more, please. Had a little bit of a technical issue there. Back one. So yeah, we do provide independent assessment of our clients, regularly doing audits every 2 years. one of the interesting factors there is most debts these days are sort of repaid between 3 and 4 years. So they do require that constant need to have a look and see how that can sort of be improved. Having such a large team and writing such a large amount, it gives us direct access to a lot of credit departments. So we do often get more, I guess, better routine outcomes than you would normally get going straight to the bank. As a mortgage consultant or a broker or a lending advisor and such, we're not aligned, as I mentioned. So your best outcome is our main focus. Next slide, please. So as you can see, these are some of the lending partners that we deal with. Some of these are residential, some of them are commercial and cash flow lending solutions, and we'll talk a little bit about that later on. Most of them you probably already know. There's a few lenders there that will probably be new to you. Next slide, please. So some of the lending that we offer, residential lending, which I'm sure you sort of know. Matt's sort of touched on it before about the interest rates and what's happened with current interest rates. An interesting fact there is pre-COVID, I think we had sort of the interest appetite was probably somewhere where we are today. So we had interest rates of 5 or 6%. And then during COVID, we saw the reduction almost down to 2% on residential lending. While they were at 2%, banks still assessed these mortgages at a minimum rate of 5.25%. That's the ceiling they put in place. One of the unfortunate things that they had in place as well was they were leveraging clients' incomes almost up to 9 times their annual earnings. So if someone was on $100,000 worth of income, they're allowing borrowings up to $900,000. If we look at what's physically happened right now, banks have now capped it at almost 5 times the client's actual earning. So that's heavily reduced, I guess, the borrowing capacity of some of our clients, which has mitigated some risk. But I feel during that COVID period, there was probably been a few clients that once they come off those fixed rates, they certainly are going to feel the pinch, purely because their application was assessed at a maximum level of 5.25, and some of the interest rates now are, in excess of 6%. Another point to make is, regardless of what the RBA is doing with interest rates, some banks, as we saw last month, have moved interest rates up despite the RBA actually staying still. So it's not necessarily in line with what the RBA is doing. The banks are looking at their cost of funds and adjusting their rates, whether it's variable or fixed, accordingly. On asset finance, we've also seen that obviously increase quite a bit. Asset finance can be used for all sorts of types of requirements, everything from pieces of equipment, motor vehicles, inventory, fit outs. Solar seems to be quite a big, strong flavour. People trying to look at reducing their energy costs, taking on solar. And the last thing is insurance premium funding, which is a form of, I guess, smoothing out your cash flow by covering all your insurance costings over a monthly basis. Next slide. Standard commercial lending covers everything from small business, commercial, franchise funding, construction and development. Cash flow lending is probably something that we'll talk a little bit more about. Cash flow funding solutions has changed and evolved a fair bit. If we looked pre-COVID, the commercial rates were linked to what they call the bank bill swap rate, and they were quite high. So the way that we were actually funding some commercial lending was using residential security. During COVID, what we saw was that bank bill swap rate reduced to almost nothing. I think the lowest point was 0.1. And in that case, it was actually cheaper to fund solutions through commercial lending as opposed to residential and so forth. Cash flow lending is that extra step where we can fund for commercial purposes without taking into account bricks and mortar security. And as you can see there, some of the examples are invoice finance, debtor finance, trade finance, inventory finance. This is where they leverage off invoices or are able to fund trade funding solutions. So if you're buying equipment, you need to bring it in to manufacture something to then on-sell it. There are those sort of funding solutions that don't require that bricks and mortar. Few different lenders have actually changed their approach to cash flow lending now. And while they may not offer, I guess, a standardized invoice debtor trade finance, what they do is allow for term funding facilities to be established, but they look at value in businesses in things like equipment, inventory, and their age receivables ledger. And that's where they see true value in particular businesses, and they lend against that, instead of the traditional bricks and mortar security. Other types of lending that may or may not interest you is self-managed super fund lending. This can be done for residential or commercial. We've seen a fair bit of its reduce around that, mainly around the residential funding, not a lot of interest happening around that. I think the main benefit is for business owners to look at potentially selling their premise to their super fund and becoming their own tenant. That's the bulk of the self-managed super fund funding that we're sort of seeing at the moment, though it is still available for residential purchases. I guess the providers in that area have sort of reduced over the last sort of 4 years. Agribusiness, everything from rural property to livestock finance, which is off balance sheet. So this is where a farmer can actually go and buy livestock and not actually physically own it. It's off their balance sheet. The last point there was private funding. Private funding is an unregulated purpose. It is short-term funding, everything from a week to 2 years. Clients do use it for, I guess, bridging facilities, though it is meant for unregulated purposes. We can adapt private funding for development as opposed to your traditional applications where you require pre-funding and pre-settlements to secure the funding. Private funding becomes very commercial and manual. Next slide, please. One of the things that I think Findex prides itself on is around the actual advice that they give their clients. And it's not so much a pricing point of view. I mean, we're personally not driven by pricing because the way that we operate is not linked to that. But there are specific benefits for certain industries. As mentioned there's medical, law and accounting. Security structure is probably, security and guarantee structure is probably the more important thing when we're looking at loan structuring and advice. Banks often want to have as much as they can around security and guarantees. And one of our jobs is really to shave that down and ensure that there's adequate security for the bank, but without giving the bank absolutely everything that a client holds. So there's things around the title ownership that can potentially change, and even the guarantee structure, removing things like unlimited guarantees across all the directors, maybe having them linked to their shareholding in that regard. But there's a lot involved in the structuring and advice, and it comes back to having your debt reviewed on a continuous level. I mean, I think with commercial lending, most banks now are trying to move away from reviewing, I guess, lending under $2 million on an annual basis. It takes a lot of time to review lending in that respect. So any lending over $2 million often gets reviewed on an annual basis. And the banks have moved now to more of a set and forget model for anything under that. So again, whether it's residential or commercial, I do encourage most of my clients to have their debt reviewed at least on a 2-year basis. And that's pretty much from me. That's the lending landscape. If you've got any questions, by all means, feel free to send them through the chat. I'm happy to discuss this further. Otherwise, over to you, Chase.
Yeah, thank you. We're now to the Q&A portion. So if you guys have any questions, please send them through the Q&A. I've got a few questions. So Rachelle, if I wanted to review my current financial processes, how would I go about that? And can you give us maybe some quick wins that businesses could look at getting when they do so?
Yeah, absolutely. So with the current financial processes, some of it's just around stripping it down and just understanding who's responsible for what in that process stream. It is going to be looking different from industry to industry. So just understanding how that fits together. I'm a big picture drawer. So even listening to my colleagues here, I'm drawing little diagrams off on the side to really connect up the dots together. So I'm really big on actually physically mapping that out on a piece of paper, understanding how that's happening, and then being able to walk back and look at each of those steps and how to streamline those steps. In some cases, you're going to be wanting to put a better or more secure process in place to assess risk. If you're taking on new customers, it might be a more secure process around assessing your debt levels and your financing to get that reviewed. Or it might be looking at that process and deciding that actually that step isn't adding value for you. How do you actually automate that and to have that happen a lot faster? So just around mapping it out and then examining each step of that process. There's a lot of tools out there now, like we're finding the business software space is really rapidly moving, and there's some really great tools to get into your tech stack to connect up your systems so that they talk to each other, and that makes your life a lot easier in the long run.
Yeah, well, so you mentioned snapshot reporting in your section, and I think it sounds great, right? And I think, large businesses across Australia have the benefit of, internal tech teams, et cetera, but SMBs may not have the ability to get snapshot reporting as easily and connect the tech stack. Like, what would be your recommendations for, actually integrating that tech stack so someone could see snapshot reporting that'll drive those insights that you talked about?
Yeah, absolutely. So there's some great tools that integrate with a lot of the base accounting systems particularly for small businesses at the moment. So if you're using a Xero or a QuickBooks or an MYOB, there's tools like Spotlight that will integrate into your systems. And there's a bit of work to build the reports that will give you the insights that you need. But once they're built, then it's a relatively easy method to really just check in on those business drivers on a regular basis. It might be Fathom, for example, if you're working off MYOB. There's an opportunity to use Power BI to actually, pretty much all these packages export to Excel. I'm pretty sure the financial world still runs on Excel. So you can export that and build your own. If you're in agriculture, one of the regular packages that we use is Figured, because again, it's integrating with the underlying systems that you've got. So Spotlight's a great one. Fathom's also fantastic. Figured is industry specific. What I would suggest that you do as the first step is have a chat to your advisor and see what they're experienced with, see what they're comfortable using and what they think is going to integrate best for your business and your industry.
Awesome. And if a business was already running into cash flow problems, which I'm sure some are, what would you tell them to do?
Yeah, yep. No, that's a good question, because there will be some that are already experiencing a fair bit of pain. The first is to, cash is king, right? So having a look at what your systems are around particularly if you are operating on an invoice basis, making sure that you've got really strong processes around your debtor days and your collections. How, can you change that? Have you got great terms and conditions in place? Are you using all the security methods that you've got, like PPSR registrations? What I would say is, before you get into that really, really tricky stage, make sure that you look at getting a structure and risk review. So there's a division within Findex that does nothing else other than look at structure and risk and give recommendations to business owners on how they can protect their assets if they do get into a pretty tricky situation. And I think in terms like if you've got finance, I think it's, you know, it's always about being upfront, right? If you can see trouble coming and you need to talk to your lender, making sure that you get on the front foot and get a plan in place as quickly as possible.
Thank you. And I guess that's probably a good segue to my next question for Daniel. So how have you seen banking covenants sort of change in this pre and post COVID world? Can you talk a little bit to us about that?
Yeah, it's a very interesting question, and it's purely driven by that bankable swap rate that we sort of spoke about. Banking covenants, not only around security, but interest coverage and debt service ratios all get taken into account. And, you know, when banks are sort of applying their general rule to things like interest coverage, they were, you know, the BBSY was at a sort of stable rate. And when it reduced to almost nothing, what we're seeing now when we're doing commercial lending reviews is that a lot of companies are in breach of some of those covenants. So, I mean, banks have had to become a little bit more negotiable around that and see, I guess, the greater picture. As long as the other indicators of a business are performing well, they are letting certain covenants slide, where previously it was sort of a hard and fast rule. If you didn't meet all your covenants, that was it, that you're getting turfed out. So they've had to evolve with what sort of happened. It's sort of, we haven't seen BBSY drop to almost nothing, and then, you know, within 12 months sort of restore itself back up. So yeah, interesting times, but it is driving that review process. And yeah.
Yeah, it's interesting how that's shifted, and I think speaks to, you know, the power of sort of speaking out and really pushing for what you can get. We hear a lot about the construction industry in the news. How is construction appetite and risk being managed?
Yeah, so I mean, risk is they're trying to manage risk first and foremost. As we've seen, the construction industry has sort of taken off, but one of the main issues around construction is material costs. So material costs have blown out. When we're talking about residential lending, even something as simple as a fixed price building contract has changed now to cost plus build. And I guess the way that the banks are managing that risk is by doing their own costing report. So they're arranging their own QS to come in, do an overall costing report, and throw at least a 10% contingency into that build cost. So for consumers in that respect, they're having to factor in a contingency that they've not previously looked at. And that's giving the bank a little bit of extra comfort, a little bit of extra buffer. On that commercial and development side of it, they're asking for sort of greater pre-sale amounts. And they're sort of only really wanting to take on development deals and transactions from builders that have got certain risk management tools in place. We've seen recently Porter Davis down in Victoria has gone in liquidation. Some big players there have been heavily affected. So, you know, while construction remains a flavour of residential and commercial, the risks are quite high purely because of material costs.
Interesting. And I guess, Matthew, kind of connecting the bigger picture and probably the big hairy question that you get asked a lot, what are our chances of recession in Australia?
Less likely in Australia, Jason, than they are expected to be, say, in the US. There's not a high expectation that we'll go into a recession here in Australia. The Reserve Bank's still forecasting GDP growth this year of 1.5%, so only just eking out a slight return, and 2.5% in 2024. But don't forget, our economy is very much top heavy in that financials and resources. Those two sectors make up a large component of GDP and production and so forth. So, banks typically do well in a rising interest rate environment. Their margins do improve. We've spoken a lot about banks today. But then also the demand for our commodities and primary resources continues to be really strong. So they will underpin our economic growth. So the expectation here, long story short, is that we won't enter a recession, albeit growth will be pretty muted for the next 12 to 24 months.
And what does that mean for investment markets?
Again, how long's a piece of string? I'll draw you back to the original disclaimer. Generally speaking, look, it is really a difficult one that we're grappling with. Look, we expect that there's going to continue to be volatility, and I know you probably hear that a lot from all investment types. But the reality is we've got a situation where earnings are going to come under pressure with publicly listed companies both here and overseas. Just as a result of all the things we spoke about earlier, input costs and rising interest rates and so forth. That's going to have a damaging effect on company earnings, which keep on getting revised downwards. So as a consequence, that typically will then feed into share markets. Now, the question is whether or not the share market, because it typically looks through a lot of this, share markets typically have a 12-month plus horizon that they look through. So the question is whether or not the share markets are already looking through that, because they've been rallying really quite strongly. But I guess the thing to mention there is that the US is expected to go into a recession, or it's around a 50 or 60% probability that they will head into a recession at some stage, probably in 2024. And throughout history, there's never the S&P or the US share market has never bottomed out before a recession in the US, which suggests that if we do go into one, there will be potentially another leg down in investment markets, and Australian share markets typically do follow suit. So nothing's a lock, but these are all the considerations that suggest that yes, there will be more pressure on investment markets, and there may still be some easing in share prices, but you can't discount the fact also that the market is already looking through all of this sort of stuff, and the trajectory will continue. It's probably a good economist's delivery of sitting on the fence, Chase.
Yes. Well, I think it's interesting. I mean, I think despite some of the doom and gloom we're talking about, I think there is silver linings here. And I think it's good to kind of talk through what the opportunities are. So, I really appreciate all the attendees today, and want to say thank you so much from the team at Findex for speaking. After this webinar closes, we'll send a survey. Please fill that out. We want to continue to provide great content to our customers at EH. So would love to get your feedback on the survey. We'll also be sending out some additional resources after the webinar, along with today's recording. So thank you again, everybody. Have a lovely afternoon, and we'll talk to y'all soon. Thank you.